Hello, and welcome to another edition of CAP STRAT this week. Today, we will be diving in on, you guessed it, the Fed.
Other stuff too.
And some more stuff. We'll expand on it a little bit. But Mike, the main thing we wanted to talk about today is changes in expectations for the federal funds rate and how different areas of the market are interpreting that and reflecting that in prices. So we figured we'd kick off today's video with looking at Fed funds futures. And we've got a couple of different time periods here in purple coming into the year, in black where Fed funds expectations are today, and then blue is the CAP STRAT forecast for 2024. And as you can see here, the market is starting to move closer and closer to that CAP STRAT forecast, taking cuts off of the table for 2024, pushing them back further into the future, and getting a little bit closer to our expectations coming into the year. Yeah. And what's particularly interesting about that is the way different areas of the market are starting to internalize that message. And so we'll start here with fixed income, looking at returns as of February 9th, and you can see a good amount of red across the board with rates rising. So what's going on in the fixed income space with regards to this messaging?
Yeah, you're seeing the 30-year sell off, those yields rise, 10-year yields back up. Shorter term yields are sort of holding their own, but there's not a lot of duration there. So generally speaking, the economic data has been hotter than expected, which is creating concerns that that's perhaps too much of a good thing. And that might delay the progress or stall the progress we've made on disinflation, which will then mean the Fed is later to cut, which then gets reflected in bond markets. And
the old good news is bad news.
Exactly. And we've had so many cycles of this over the past 2 years, the no landing to the soft landing to the no landing, that we know the bond market tends to sniff this out first and react first. The last such episode we had was July 2023, where this phenomenon was starting to happen, sort of too much good news on the economic front, potentially worries that we're not going to make as much progress on inflation, putting the Fed on hold for longer. And the bond market sniffed it out first in July as well, last July.
Right.
Yeah.
Yep. And you contrast that with performance in the equity space over the past week, where the green returns just keep rolling in.
Yeah.
Especially in the growth side of the market, large growth, small growth, both up over 2.5% for the week. So what's the difference there?
Well, the sort of least susceptible to this phenomenon, this too hot, going from Goldilocks to perhaps too hot, are the large caps, because 30% of the S&P 500 is just made up of 7 stocks. And year over year, they're growing their earnings in aggregate at something like 50%, whereas the rest of the market far more sensitive to needing rate cuts in order to get earnings to bottom out and come back up. So sort of the last place to feel it would be large growth. And then within the equity market, the areas that are more sensitive to this idea of needing rate cuts perhaps would be the smaller caps. And so, year to date, in aggregate, small caps slightly down. Obviously, differences between value and growth. That main difference there coming from what's going on with regional banks, which are heavily concentrated in small value. So we can touch on that later as well. But definitely want to spend some time talking about what we're seeing in the large cap space versus some of the developments in the small cap space, particularly around commercial real estate and banking.
Yeah, absolutely. And so let's dive in, on the large cap side, right? We've talked a bit recently about how potential for a policy error and for that to have a significant impact on markets is high right now. So we wanted to put some numbers behind that. So maybe if you could, start by just walking us through what are these two lines here and what do we mean when we say, extended positioning versus overbought, oversold?
Right. We had a great question from a client last week. We get many great questions from clients, but it was basically, hey, you all thought rate cut expectations were going to come out of the market and that the market was sensitive to that and perhaps there'd be a pullback. Well, it looks like rate cuts have come out of the market. Why isn't the S&P 500 selling off yet? And the answer is it might just take some time. When we look at near-term positioning and momentum, large cap stocks are getting very vulnerable. So up top, what we look at is net futures positioning. So by net positioning, you'd mean net long. If the number's negative, then speculators are net short. And so we have these green and red lines here. Those are 1 standard deviation lines. So this is actually the most extended or net long S&P positioning in S&P 500 futures contracts has been since 2021. So there just isn't a whole lot of, everybody's so long, everybody's so extended. There might not be a whole lot of room for investors to extend their positioning even further. Maybe we're just running out of new buyers, right? And so we think that, once again, makes us very vulnerable. And then going to sort of a shorter term oscillator, if you will, the 30-day RSI, or relative strength index. What it does is it measures the number of days in the past 30 where the S&P 500 price goes up versus down, and the magnitude of those moves to give you an idea. Are we overbought? Not good. Or are we oversold and potentially ripe for a reversal? And we've been overbought. We've been hanging around in overbought territory. The last time we were this overbought, coincidentally, was July 2023. And in July 2023, we saw economic data coming in really solid, too hot, expectations for cuts coming out of the market. The bond market reflected it first. Then it was the smaller, sort of weaker areas of the equity market that started to break down. And then the last thing to go was the S&P 500. And then from August through October, it was a really tough go of it.
Right.
So we still think there's potential for that. It's just, particularly because positioning is so stretched, there's just been this long conditioning period where why would you ever want to sell the S&P 500 or the MAX 7, right? But definitely think there's potential for a pullback or at least a consolidation here for large caps.
Yeah, and that's become somewhat of an MO for this market in this cycle, but that kind of aligns with historical market reactions, as the fixed income market tends to price things in a little bit sooner than the equity market does. So not entirely outside the realm of expectations at this point.
Yep. Further to the point.
Right.
On the S&P 500 and the stretch valuations, we talked about stretch positioning, being overbought. The valuations are getting pretty stretched as well. So the S&P 500 forward earnings yield right now is 4.15%. If you want to do the math at home, that equates to 24 times next year's earnings, which is very expensive. But under the hood, there's a big difference there between the Magnificent Seven, which are at 37 times earnings, and the other 493, which obviously are far less than that. But so that's the most expensive PE ratio the market has had, since sometime in 2021, back when interest rates were at 0. So that to us is important. And we always have been relating the earnings yield to the cash yield, right? There is alternative. The 3-month Treasury bill yield is still at 5.25. And with rate cuts getting pushed out, it's going to be at 5.25 for longer. We think it'll be above 5% for at least the first half of this year.
Right.
So that's another, it just shows once more, the valuations here are getting pretty pricey, and we think there are definitely better risk-reward opportunities in other areas of the equity market. You look at small caps, for example, you have to think if the S&P 500 were to pull back here in the near term, okay, small caps would definitely fall as well. But you think 12 months out, the risk reward there for things like small caps, value areas of the market, far more attractive than the S&P 500 being so top heavy, so expensive. So as we take a longer time horizon, that's definitely an opportunity, especially when the Fed finally does start cutting.
Right. Yeah. Yeah. Important for us to continue to harp on the relative opportunities within the equity space, right? Not just paint too broad of a brush. And so maybe, diving into that a little bit further, talking small caps, particularly small value as a potential area of interest. One of the things that's been percolating, especially on the small cap value side, is regional bank exposure and concerns around potential problems in the regional banking system. So wanted to dive in a little bit further on the New York Community Bank Corp issues, talk about that a little bit, and help our viewers, compare and contrast it with recent banking crises.
Yeah. So New York Community Bank Corp, just since they reported earnings on January 31st, now that sort of the dust has settled, it's very clear that this bank was under-reserved, had insufficient reserves based on the quality of the assets on their loan book. They were under a lot of pressure by regulators to increase reserves in order to meet a stricter regulatory threshold that coincides with them moving up into the $100 billion asset tier.
Yep.
Right? So a lot of pressure by regulators to raise capital, but their loan book was extremely unique. A large chunk of their loan book, about half of their loans, were commercial real estate, with a significant portion of that commercial real estate book being concentrated in rent-stabilized apartment buildings in New York City. A very specific asset, right? That, they're the biggest lender in that space in the country. And what's unfortunate about that asset is, given that they're rent-stabilized, landlords, owners of those buildings were not able to increase rents enough to offset higher maintenance costs, reconstruction costs, improvements to the building, as well as potentially higher interest costs when they were going to roll over their loan. So it was a lot of things, a very unique loan book, and a lot of these pressures coming all at once. And, we debate internally if they had not been under pressure to raise capital just because of moving into that $100 billion threshold, would they have even had to take these losses, set aside this money for loan losses this quickly? They would have eventually, most likely, but not all at once, which is sort of the shock and awe, right? So we debate that. But all that said, they're not experiencing deposit flight. So that's what's quite different from Silicon Valley, Signature Bank last year. There doesn't seem to be a run on this bank. And now that the market has taken time to digest all this, the market seems very comfortable that the other regional banks in the small cap space that have ample reserves, relatively speaking, to New York Community Bank Corp, have much more diversified loan portfolios, aren't heavily concentrated in this one unique asset class that's, a really tough place to be. And also, importantly, have been in the same regulatory tier for a few years, have gone through stress tests, that they're going to be able to handle this and there won't be contagion. So you're seeing regional bank indices recover a lot of the losses they've experienced since that sort of shock moment from New York Community Bank Corp. So in the near term, we don't think this is something that's going to upend the attractiveness 12 months out of, for example, small value. But we also don't want to overstate, because we're not saying commercial real estate is not a problem. Commercial real estate is a big problem. And this chart sort of shows, in our view, starts to show the magnitude of the problem. We recently, the responses to the Fed's senior loan officer survey came back. And if you specifically look at the commercial real estate sector, you look at the percentage of respondents that are tightening standards for commercial real estate loans. So these are banks responding, right, or loan officers. It's very elevated. I mean, we're at recessionary type levels. So if you own a CRE property and your loan is coming due, good luck. You better have a really high quality asset, and you better be able, even then, you better be able to stomach higher interest costs, right? These are risky loans for these banks. And then because of that, what you're doing is seeing no demand for CRE loans. Let's just wait and see, right? Extend and pretend. This is, the CRE problem has been a known, but what's been unknown is the true market value of these properties. Because if there are no sales,
how do you gauge it?
How do you get price discovery? How do you determine what these things are really worth? So as long as the sales activity in this space is a trickle, we think the larger, more important banks can probably, hold their own and take care of this. It'll be a bit of an earnings headwind, but they can take care of it. But if that trickle speeds up to a steady flow, that could potentially be an earnings problem for banks that have CRE, and disproportionately, it's a problem for smaller banks.
Right.
If you look at banks with under 10 billion of assets, so we're talking community banks, they have half of the total CRE loans in the U.S. So those banks, some of them are going to fail, a lot of them are going to get absorbed, and we think the Fed will, just like they were so quick to respond in a Silicon Valley type situation, they're probably not going to do the same to bail out banks under 10 billion, but they're going to be there to extend support and liquidity in some way, shape, or form. This will be a long-term problem that the banking system will be dealing with. If they had to deal with it all right now, it would be really ugly.
Yeah.
Right.
Hopefully
the good news is the extend and pretend, it's out there, it's happening. So.
Yeah. Just an eye-popping chart. I mean, just looking at these levels, right?
Mm-hmm.
Recession every time.
Yeah, and it's not just a problem in the U.S. I mean, foreign banks, they have exposure to U.S. Commercial real estate as well. So you're seeing write-downs, charge-offs there as well. So this is a known. It's a big issue. As long as it's a trickle, it seems manageable, but it's too soon to tell. I mean, we're going to be talking about this throughout the year.
Yeah.
So
right.
Reason to stay tuned.
Yeah, definitely something to keep an eye on with us, for sure. So with that, let's dive into the investment framework.
Let's do it.
Components. We've got economic growth. So, GDP now cooling down a little bit, but still at 3.4% for Q1. Economic growth appears to continue to be strong.
Yeah, it does. And, GDP, it seems like GDP is overstating it if you compare it to things like GDI, which should be the equivalent. But regardless, the market is looking at this and thinking, wow, this is incredible to get this much disinflation with this strong a growth. The risk is that the growth is too strong and the financial conditions are too loose and inflation kicks back up.
Yeah, right. Exactly. And speaking of inflation, we've got our updated forecasts here. Mm-hmm. Anything notable for us to hit on from an inflation perspective?
Last week, sort of the boogeyman was the annual CPI adjustments. The good news is those didn't really move the needle. The adjustments were very mild, and they didn't undo that sort of disinflation progress that we had seen late last year. So that's the good news. The tough news is January CPI is coming out this week. I mean, I imagine by the time people are watching this, we will have already received the January CPI print. We would expect there'd be a bit of an acceleration in CPI. Some of that is just due to January. A lot of firms wait to raise or lower prices, wait for price adjustments until the next calendar year. So the January one's always volatile. The Fed's going to take it with a grain of salt. They're looking for, now they say they're looking for, what exactly is the term they're using? Broader disinflation or something. Disinflation. Which basically means you need, you need services inflation to come down. It's what we've been talking about the whole time. If services is still accelerating, that's going to be a problem.
Yeah. Right. And then liquidity front, we've talked about some big updates to the liquidity forecast over the past couple of weeks. Anything else we want to add on here?
We haven't had to really adjust our liquidity forecast too much, even though cuts are coming out of the market because the market has just moved towards our forecast.
Right.
So we're still hopeful that you're going to get rate cuts in the back half of the year, which is going to create a much more favorable liquidity environment for equities, particularly those areas of the equity market that have been left behind. But that's what we're looking out for. If we move from Goldilocks to too hot, then this liquidity forecast might come down, and that would change our outlook.
Yep. Makes sense.
Mm-hmm.
All right. And then we'll wrap up with the recession signal. Remains not active.
Yep.
Market stress indicators still far from any recession signal triggering levels. Mm-hmm. Anything else you want to tell our viewers about here?
In terms of credit spreads, those are so tight right now. We talked about how expensive the S&P 500 is relative to earnings. Credit spreads are equally expensive. They're very, very tight. And we're seeing a lot of companies just go ahead and issue in January, just raise debt, raise more cash, do debt issuance, a surge in issuance. So it's a very interesting time. financial conditions actually are quite loose
Yeah.
based on this activity, people rushing out to raise more debt. And what a lot of companies are doing is saying, all right, it seems like a good environment right now. I'm going to do that bond issuance, even though I don't need the money, because I'll just take it and put it in 6-month or 3-month treasury bills till I need it, right? And earn a good
take advantage of that appetite.
So there are plenty of ways to manage it.
Yep.
Yeah.
All right. Well, that'll do it for this version of CAP STRAT this week. If you have any questions or comments, please feel free to reach out.